Let's talk about options now. We have done futures and forwards. Let's move forward with options. Options is another kind of derivative which I told you in the previous uh, video. It is fundamentally very different from forwards and futures. Forwards and futures, in forwards and futures, there is a symmetric relationship between the person who's shorting and the person who's longing, or the buyer and seller. Whereas in an option, there is no symmetric relationship. There is an asymmetric relationship in case of an option. Now, what is this symmetric and asymmetric relationship? Symmetric relationship is where both the buyer and seller have the right as well as the obligation to buy and sell the contract. So, the buyer also has the right, the seller also has the right. The buyer, when the seller exercises his right, the buyer has an obligation to uh, honor it, and when the buyer exercises his right, the seller has the obligation to honor it. So there is a symmetric relationship between buyer and seller. Whereas in an option, one person or one party to the contract has the right, whereas the other party has an obligation only. So there is an asymmetric relationship here because the other party does not have the right. He has only an obligation to buy or sell the contract. Okay, let's understand what is an option. An option is a contract which offers the buyer or the person in the long position the right. So, the buyer of the option has the right but not the obligation to buy or sell a security or another financial asset at an agreed upon price. Now, there are two things that he is buying. He is buying an option wherein he is getting a right. Right of what? Right to buy or sell a security or other financial asset. Now he's number one, he's buying an option. Number two is he's buying an option for the purpose of getting the right to buy or sell the underlying security, right? At an agreed upon price, which is the strike price. At the same time, the seller of the option contract. Now here I am telling about seller of the option contract. The seller of the option contract has the obligation to sell, to exercise whatever the buyer of the contract puts him into. So, the seller of the contract has an obligation to honor his obligation, has an obligation to honor the contract, whereas the buyer of the contract has a right. I hope that's clear. So, why would the seller of the option contract get into an obligation? Why will he do it? There must be some incentive for him to do it. The seller of the option contract gets premium for selling his right to take decision. Now, we did forwards and futures before this, and there was no premium involved. But here, there is something called premium. So, the seller of the option contract, because he's selling his right, he's getting into an obligation. So that obligation may result in a loss as well. So to set off or to trade off that loss that he's going to make or he might make in the future, he gets some premium from the buyer of the option contract. This is what is written. There is no premium involved in forwards and futures. Now this I've already explained. There is a buyer of contract and there is a seller of contract. Number one. Then there is a right to buy. The buyer of the contract has the right to buy the asset in case of a call option. There are two kinds of options, call option and put option. Number one is you buy the option. What does the option entail? The option may be a call option, the option may be a put option. So the person who is in long option, long who is longing the position is always buying a contract. So I am person A, I buy an option contract. The option contract now may be a call option, maybe a put option. What is a call option? A call option will be an option wherein I, the buyer of the option contract, gets the right to buy the asset or security at a future date. Whereas in a put option, I, the buyer of the option contract, gets the right to sell the underlying security or asset at a future date. So put option is the right to sell the underlying security, whereas the call option is the right to buy the underlying security at a future date. Both these rights are given to the buyer of the option contract only. The seller of the option contract has an obligation to honor his contract. Now let's understand the payoff graph of a call option contract. In a call option, I, as a buyer, let's say I am the buyer of the option contract and I decide to buy a call option. So what will be the graph of my payoff or profit? This is the graph of my profit. How did I come to this? Let's take an example to understand this. Person A decides to buy an option contract which says that 1 year after this contract, person A will have the right to buy an underlying security at the rate of rupees 100. This is what the contract says. Person A is given the right to buy an underlying securities, say rice, at rupees 100 per kg. After 1 year, the price of rice goes up to 1000 per kg. What will you do? The person who has the right to buy the rice will exercise his right and buy it at 100 rupees per kg from person B who has an obligation to sell, and then person A will go to the market and sell it at 1000, making a profit of 900. What if the price goes up to 10,000? Then the profit is 9,900. What if the price goes up to 1 lakh? Then the profit is 99,900. So there is no limit to the profit that the buyer of the contract, buyer of the call option can make. The profit is unlimited, whereas the loss is limited. Why is the loss limited? What if the price goes down to 90? When the price goes down to 90, I will just not exercise the right. I will say that I have to buy it from you at rupees 100, whereas I can buy the same thing from the market at rupees 90. So why take it from you? I will rather take it from the market. So the loss is limited here. Here the loss is given as 0 because premium has not been taken into consideration. But if we take premium into consideration, then the loss is limited to the amount of premium. Let's say the amount of premium is 5 rupees. So if the price goes down to 90, I will not exercise it because I will have to pay 100 rupees to buy the rice from the seller of the contract, and then I will go into the market and sell it for 90, making a loss of 10 rupees. So I will not exercise it. I will rather be happy with the loss that I have already made in terms of giving premium to person B. So that premium is the maximum loss that you can make as a buyer of option contract, as a buyer of call option. Let's come to put option now. In put option is the right to sell. The right to sell. I as a buyer of option contract has the right to sell in the future because I've taken a put option. Okay. So when will I exercise this right? Let's say I enter into person A enters into a contract with person B that after 1 year I will sell 1 kg rice for rupees 100 per kg. Now I have the right to sell the rice at rupees 100 per kg. What if the price of the rice goes down to rupees 0? It's available for free in the market. Let's take an extreme situation. The price is 0 now in the market. So I will buy from the market at rupees 0, which is for free, and then I'll go to person B and say, see, I had the right to sell to you at rupees 100 per kg, so I'm exercising this right. So you have to buy it at rupees 100 per kg. Now the other person has an obligation to honor the contract, so he will buy it at rupees 100 per kg from me. So we have a put option here, where the holder of the option has the right to sell the underlying security at a future date. Okay, so the profit is limited to an extreme situation where this is 0, where the market price in the future is 0. Now, what about the loss? The loss is, what about the loss? The loss is limited. Why is the loss limited? I have the right to sell. So, I will exercise this right only when the future price is less than the strike price, exercise price. What if the future price is more than the exercise price? Rice is available in the market for 150 and I have the right to sell to this person at rupees 100. So what if I decide to exercise this right, what will I do? I will buy it from the market at 150 and I will sell it to him at rupees 100 per kg, making a loss of rupees 50. I will rather not exercise this right then, right? So if the price goes above rupees 100, then I will not exercise this right, and so this is a flat curve here. So these two things are important. There may be a graph shown like this, and the examiner may ask what kind of option it is, call option or put option payoff. So that may happen. Let's come to European versus American option. Very small thing. Very small one marker may be asked from this area. A European option, in case of a European contract, the buyer of the option can exercise his right only on the expiry date. If the option says that after 1 year we have to exercise this right, then he can do it only after 1 year. Whereas in an American option or an American contract, the buyer of the contract who has the right may exercise his right at any point of time until the expiry date. Even after 6 months, if the price goes up, and if I am the buyer of the if I have purchased the call option, then I will exercise that option and make a profit. That is the basic difference between American and European contract. Now there are three important terms in option contract. First is premium. Premium is the money that you pay to the person who is entering an obligation. So he is getting some money for the obligation that he is entering into. Second is expiration date. Expiration date, you must have understood by now, is the last date on which the contract can be honored. And the strike price is the specified price at which the option can be exercised. So strike price is similar to exercise price, same as the exercise price. These are the two different terms that they have. So it's the price at which the option can be exercised at the future date. Let's come to the relationship. Relationship is very important. Through the example that we did, we understood that if the actual price at the end of the contract is more than strike price was rupees 100, I had the right to exercise the contract at rupees 100, whereas the actual price of rice in the market was 1000. So in this situation, actual price is more than strike price. So I will be the buyer of the call option will be able to exercise the option contract because he'll be making money in this case. Whereas if I have purchased a put option, that is, if I have purchased the right to sell at a future date, then I will not exercise this option. It is otherwise, it is just opposite to what happens in a call option. So he'll be out of money. Out of money is when you don't exercise the right. In the money is when you exercise the right. Similarly, when actual price is similar to strike price, then both are at the money. That is, there is no profit, no loss situation. And when the actual price is less than selling price, less than strike price, then call option is out of money because he'll be making a loss if he exercises the right. So he'll not make the he'll not honor the contract. He'll not enter into the. He'll not utilize his right, and he'll be out of money. At the same time, put option will be in the money because he'll be making profit here. So this is about options. Let's come to currency options, another kind of option. The one that we just did was normal option. Now we are coming to currency option. It's just similar to an option. There are just some minimal changes that we have made here. Let's take an example to understand. A pound option call contract. Now what does this mean? This means, and it's a call contract, so it's a right to buy. It's an option, right to buy through a call, and it's a pound option. What does this mean? This means that I or A has the right to buy pounds at a future date. Okay, please just remember this. Pound option call would mean here is right to buy pounds at a future date. Has a strike price is the price at which I can exercise the right in the future date, which is $1.820 per euro, and a premium of 0.08. This is the premium that I have to pay to the other person. Spot price is the present price of the uh, underlying security in the market. Spot price is 1.920. Spot price on maturity is written here. This means that at the rate of maturity, the market price or market value of the same contract is 1.920. Find gain or loss to option buyer and option seller. What will happen to the option buyer? Now, option buyer here has the right to buy pound at a future date. I, as an option buyer, have the right to buy pounds at a price of 1.820 per pound, right? Whereas in the market, the price is 1.920. So I will buy this at 1.820 and go to the market and sell it at 1.920, making a profit. Here, the actual price is more than strike price. Now, as we did before, just before this, when the actual price is more than strike price, the holder of call option is in the money, which means he will exercise the right because he'll be making profit. What profit will he make? 1.920 minus 1.820 minus 0.08, minus 0.08 because he's paying a premium to the other party of the contract for exercising his right. So this is the profit that he makes. This is multiplied by 62 to 500 here because in the financial terms it is considered, it has been taken as a standard that dollar to pound minimum lot is 62,500 units. Just as we did in forwards and futures, the minimum lot was 100 in case of a nifty uh, stock. Similarly, it is being taken as a standard lot for pound to euro exchange. 62,500 is the minimum lot. That's why it is taken as 62,500 into 0.02. That is not important. Loss to option seller. What will be the loss to option seller? Now the option seller has an obligation here. So no matter he is making a profit or loss, he will have to exercise his obligation. So his loss will be 0.10. 0.10 is the difference between 1.920 minus 1.820. So he will, because he will have to buy this security or this exchange from the market at 1.920, whereas he can sell it to the uh, other party of the option contract at only 1.820, thereby making a loss of 0.10, whereas 0.08 is the premium that he is getting. So this is the profit that he is making anyhow. So we subtract this and we get 0.02 again. This is the loss to option seller. This is what is currency option in place of normal exchanges between of stocks between two people. Here we have exchange rate being considered. That is how it becomes different. Otherwise, it's similar. In the next lecture, we'll come to swaps, which is the last one that we are going to cover in derivatives.